Well, hello everyone, and hope you're all having a great Wednesday. This is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. Well, tonight we've got a great event about futures, and Bennett McDowell will be presenting. Before we do get started, if you could all just type a hello in the questions area, maybe even type in the city or state you're watching from. That lets me know that yes, you can hear the audio and see the webinar screen. All right, while you're doing that, I'll let you know a little bit about Bennett. He is an expert in technical analysis, in money management for traders, psychology, and futures. And Bennett has been trading for many years and has written a number of best-selling books by John Wiley and Sons and also McGraw-Hill. So looks to me like, I guess, Jim, good, glad, welcome from Thousand Oaks. Good to see you here. I know you like Elliott Waves, just saw you the other day. And good to see you, Steve and Ike and Alan. All right, well, Bennett, I think without further ado, I will turn it over to you.
Okay, great, Jeannie. Thank you. Great to have everybody here. Good sized room today. So welcome everybody. We're going to talk about futures. How many people out there are currently trading the futures markets? And if so, tell me what kind of trading. Are you day trading them, or are you position trading them, or a combination of the two? All right, good. Quite a few. Mostly day trading. Yeah, I like day trading the futures market too. I think it has several advantages. We'll talk about that versus, of course, day trading stocks. And we have a day trading room that we run here, and it's a lot of fun. It's great. All right, so let me get going here. I got a few administrational items I've got to handle here. First thing, tell you a little bit about the risks involved in trading the financial markets. Doesn't matter if you're trading futures or stocks. We deal in a realm of probability, so we always have to take risk into factor when we place our trades. You need to know how to do risk control. You also need to trade with money you can afford to risk, called risk capital. And of course, past performance does not guarantee future performance. And it is possible to lose some or all your money short-term trading the financial markets or even long-term investing in the markets. Always possible. But in any case, check with your financial advisor or money manager before actually beginning any type of trading situation, whether it's futures or stocks, because they know your personal situation and can tell you how much money you can afford to risk in these ventures, as well as certain commitments you may have that they are aware of, and of course we are not. So definitely a good idea to check with them. I want to invite everybody to our website at traderscoach.com and also the appliedrealitytrading.com website, where we talk about our software, and we do a lot of coaching as well. So the two kind of are a good synergy together. I've been doing this a long time, going over a little over 30 years now in trading the financial markets. I'm 65 years old this year, and so we've been at it for quite some time. Website's been around since, I guess I designed the website in about 1998 and went, I guess, totally public in around the year 2000 with it. So we've been around for quite some time, helping traders worldwide, and it's really a great venture. Okay, so we got quite a few books. Jeannie will put I guess, a link up in the chat area. So if you locate that, you'll be able to find the link for the books here. But I've got a new book called Money Management for Traders that came out last year. It's been a huge success. Great book for implementing risk control. I've got the Elliott Wave Techniques. I got my new edition of the Art of Trading coming out this year. That'll be a brand new book. You can pre-order that. And also Survival Guide for Traders and Traders Money Management System, which is a deeper dive into money management and risk control. All right, so let's talk a little bit about futures out there. Basically, a lot of people talk about futures and commodities, and they kind of intermingle them as the same thing. And I get that, okay? But they actually represent different types of concepts in the market. Commodities are things you buy and sell, physical goods, such as grain, oil, metals, pork bellies, and all that kind of good stuff. Futures are the contracts that we use to buy and sell those things. Now, there are also futures on the indexes called financial futures. And that's the things like the E-minis and things like that, the S&P, the NASDAQ contracts and things like that. And of course, they are getting more sophisticated, et cetera, as more and more products come out. And you can do, you can get very fancy. You can do options on futures just like you do options on stocks. So there's a lot you can do in the futures market, but they are different than stocks. And we're going to talk a little bit about those differences today. All right, so while a commodity is a good, an actual good that gets traded, a futures contract, like I said, is the mechanism for carrying out such a trade. All right, now if we think about options, people a lot of times get options and futures mixed up because, in futures we'll deal with contracts, and in stock options we deal with contracts as well. So they kind of think they're the same, but they're really not. Okay, so an option gives the holder an opportunity or right to buy or sell something. A futures contract is an obligation, not an opportunity. If you hold a futures contract to buy, say, 100,000 bushels of corn, you're on the hook to buy corn unless you sell the contract to somebody else. So it's a little bit more definitive that way than an options contract. Now, a lot of people will talk about derivatives. How many people have heard about the derivatives? How many people know what derivatives are? Because there is a specific definition for derivatives. Okay. All right, some people know, some people are kind of new to this, so they don't. All right, so a futures represents two parties agreeing in a futures contract to buy a tangible or intangible product or asset at a specified price and on a specified future date. Both parties are obligated to carry out the contract. Right? We'll talk about, things like large cereal companies going on the futures market to go ahead and buy grain for their cereal and then lock in the price so they know what it's going to cost in the future, things like that when it's delivered. And that helps them control their costs and get loans where they need it to go ahead and fund their plantings or whatever they do, farmers, from the farmer's point of view. All right, but derivatives are contracts whose value derives from something else, like the variation of a commodity price against the stock market index. So, that type of thing, if you think of Forex in a way, you have the USD against the European and things like that. So whenever it's a combination of two things, it kind of screams out possible derivative. So technically speaking, a futures contract is kind of like a derivative, all right, because its value is derived by the commodity, right? So it is kind of the same. So when people talk about derivatives and futures, they're sometimes interchangeable. All right, an option is a derivative contract where a seller offers a buyer the right, but not an obligation, as in the case of futures, to buy an asset. A swap, how many people have heard of a swap? You see that a lot in the Forex market. All right, a swap is also a derivative contract where two parties exchange cash flows, such as interest rate payments. The interest rate calculations are agreed, and the two sides are obligated to the deal. There are also a combination of swaps and options called swap options. So I wouldn't worry about that, but we just like to mention it so you know that they're out there. All right, so let's talk about some basic first, then go in some advanced futures trading guidelines. All right, so when making the transition from stocks to futures, it can be a little bit frightening for those used to the stock market, because in the stock market, basically, it's pretty standardized. You can buy shares of this or shares of that company, and a 1 point move is a 1 point move, right? But in the futures, we have these things called ticks that kind of tend to scare people away from getting involved, and they sound complicated, but really they're not, okay? It's basically, once you learn it, it's kind of like riding a bike. You got it, all right? And different contracts, futures contracts, have different tick movements and tick values. So you do need to know that, but there's tables that help you with that. So we're going to go over that. All right, so the step one on the basic part is kind of a history of futures, and then I want to talk about why is futures better for active traders, especially day traders. I want to talk about the difference between stocks versus futures and the leverage. There is leverage that you get in dealing with the futures market. Step two, future specifics, contracts versus shares, ticks, expiration dates, limit moves, and the simplified accounting procedures. Your accountant will like you better if you trade futures because it's very easy income loss type of thing, no capital gains like in the stock market. All right, step 3, trading futures, finding the best trades, E-mini versus regular, day trading futures, when to use continuous versus dated price history of futures, and that comes down to how much history you want to look at in a futures contract, some pitfalls to avoid, and the proper use of risk control. Very basically put in step 3, the trading futures rules, once you get the ticks down and the value of the ticks, basically how we enter and exit markets and do our risk control is exactly the same as on stocks, right? The beautiful thing about technical analysis and using our system is it's based off the fractal symmetry of price movement. And you're going to get the same type of price movement in the futures market as you do in the stock market in terms of price patterns. So you can use the same form of analysis. And that's kind of important. And then finally, step 4 is advanced futures trading strategies. And this is where we talk a little bit about seasonality, Elliott wave in futures, options on futures, financial futures known as derivatives, and analyzing specific future reports like the TFF, and we'll go into what that means, etc. later on. All right, let's quickly go over some of the history on futures. Basically, in the 1840s, Chicago had become the central hub for farmers to sell their goods. These goods became known as commodities, which today is also known as futures. They're interchangeable, but now you know kind of the difference in that commodities is the underlying asset of what futures contracts trade. The futures contract as we know it today evolved as farmers, sellers, and dealers and buyers began to commit to future exchanges of grain for cash. And it all had to do with generating money now to plant their seeds to harvest later and sell to a buyer at a predetermined price. That way they got the money early to afford their plantings and then, of course, delivered their product to the farmers later. All right, so understanding futures, high leverage, it's the advantage of using margin, usually just 10% of the contract value. If you're right, you can make more money. So you usually have to put down 10%, and that's normal for most, but not all futures. Easy to go long or short with futures. Boy, that is one of the #1 things. For example, if you're day trading, let's say you're long, 20 contracts of the E-mini, and then all of a sudden you get a stop and reverse, and you want to be short 20 contracts. All you have to do is sell 40, and you're short. Unlike the stock market, where if you were long 20 contracts and you want to, or 20 shares, you want to be, or 2,000 shares, and you want to be short 4,000 shares, you'd have to cover first and then make sure that stock is sellable on a short trade. So it's a little bit more time consuming and therefore makes day trading futures, especially to the day trading stocks, especially to the short side, very, very difficult. All right, so that's why I like futures day trading better, because I don't have to worry about that stuff. All right, and not all stocks can be shorted either. You got to keep that in mind as well. So don't forget that. And uptick rule, the stock, sometimes you can't short a stock until you have the uptick against the uptick. Futures markets are also extremely liquid, at least the ones we like to trade. And for the most part, the indexes are extremely liquid. Gold is liquid. Crude oil is liquid. You've got the E-minis, the NASDAQs are liquid. The Dow futures are liquid. The Russell 2000 M2K is liquid. And they have the micro contracts today and the S&P. So there's really something for everybody out there. And those are extremely liquid markets. Markets, some that are not liquid on a very short time frame, we're talking like a 1-minute time frame, can be some of the grains and pork bellies and things like that. They usually aren't that tradable on the very short time frames. Also, too, we've noticed that Bitcoin on a 1-minute time frame, there's not a lot of liquidity there either, especially on the MBT contract. All right, so one more advantage here is E-minis are electronically traded for quick fills, but I have to say, currently everything today at this point is electronically traded. There's only like a few pits left where people are, open pit cry for fills and things like that. So it's dramatically shifted to a fully electronic market, and that's a big deal. All right, so step 2, futures contract specifics, contracts versus stock shares, the differences. Futures are bought and sold in contracts, not shares. So that's one difference. No uptick rule in futures, that's the second difference. Contracts make it easier to scale out and scale into positions. That positions are changed easily and quickly. I discussed that already. The micro contracts and the E-mini contracts can allow somebody with smaller accounts to trade more contracts, making it easier to scale in and out of markets. All right, ticks. Each future market has its own tick size. Tick size is usually what scares stock traders away from trading futures. It's true. Tick is the minimum price movement of a trading instrument. All right, there are several components that make up tick size. We're going to go over those in just a little bit, but you must understand the tick sizes on the future markets you trade. Now, we have a lot of handouts. If you're using, for example, our trade size calculator or our risk to reward calculators, we have all the PDF files in the instructions that give you all the tick values for all the futures. And in that is most important for those devices are the 1 point or the point value movements in a particular futures market. For example, in the micro E-mini, all right, a 1 point movement is $5. In the regular E-mini, it's $50. And so therefore, in a regular E-mini contract, when you have 4 ticks in a point, each tick is $12.50. And of course, that gives you your $50 value. Drop it down to a micro and you go down 10%. All right, so that way you can actually trade with smaller accounts, but keep a large amount of contracts, which makes it easy for you to scale in and out rather than just trading with one contract. So that's a big deal. All right, you must understand these tick sizes on the future markets you trade. And when you go to different future markets, you're going to have different tick sizes. For example, on the micro NASDAQ, which is the MNQ, the point value is 2. On the regular NQ, it's 20. If you go to gold, it's 10 on the micro. All right, if you go to crude oil on the micro, it's 100. So you have to know those tick sizes because that's how you calculate your trade size and know your profit and loss at the end of the position. Expiration dates, this is different than the futures market. The day when the life of a futures contract ends and is to be resolved according to the terms of delivery of the futures contract. So every futures contract, kind of like an option, has an expiration date. All right. Now, I've got a little story I can share with you. I had a friend of mine who was a big sugar trader in the futures market, and he was not a day trader. He actually took big positions, and he would also sell at times to some of the larger corporations out there that needed sugar, but he also did it privately. And he had a trade on and basically forgot he had an open position in the sugar trade, and it expired and he had to take delivery, and it was a pain in the neck. All right, so a lot of times when you have to take delivery on certain futures, you can't really take delivery. I mean, how are you going to take delivery on cattle? Okay, unless you have a ranch. Otherwise, if you take delivery, you have to pay storage fees, you have to feed the cattle until you can sell them, and so it can be a big deal if you get stuck. And my buddy that did the sugar had to actually have it delivered and store it until he could unload it, and it was a pain in the neck and costly. So you got to really be careful of your open positions, and this is where our Trader's Assistant record keeping system really comes into play here, because it keeps track of all your open positions for you, so you don't basically forget what you have open. So don't do that, okay? The expiration date's important. Just sell out of the contract so you're not obligated. All right, how many people have heard of limit moves? I know you kind of sometimes hear about that even on the stock market, but you have it more frequently on the futures market. There's limit ups and limit downs. And basically, This is the maximum amount by which the price of a commodity futures contract may advance in one trading day. And of course, a limit down is just the opposite of a limit up. This is the maximum amount by which the price of a commodities futures contract may decline in one day. Why do you think they have those? Anybody want to venture a guess on that? Why do you think they have those? Well, they have it because the brokers don't want to be exposed because everybody's buying futures on margin. And what they do is they like to freeze it before the margin gets out of hand. All right, and you could get a margin call when they do this as well. So this is one of the things you got to be careful about when trading the futures. If you have big moves, they could stop the trading based on a limit up or limit down type of accelerator. Okay, so you got to be careful about that. All right, so a little bit more on this. U.S. future traders have favorable tax consequences for short-term trades. Absolutely. All right, now, for example, in stocks, okay, if you hold positions for less than 12 months are considered short-term gains and taxed highly. All right, this tax percentage can change, of course, based on the current tax structure. Of course, everyone's tax situation is different and should consult a licensed accountant for their specific situation. But, you know, I'll give you an example. I was trading stocks heavily a while back, and basically I traded quite a few that I had as long-term holdings. And what that did is it triggered a major audit because I had, you know, 500 or 600 trades in 1 year. And many of those trades were in some of my long-term holdings. So the reason that creates an audit is they want to make sure you're not skirting the tax. All right, so you got to be careful about that. Nice thing about futures is when you make a lot of trades in futures, especially when you're day trading, you don't have to worry about that. You know, it's a P&L type of statement at the end of the year, and that's all you have to worry about. The other can get quite complicated. So just keep that in mind. I really love futures for that simplification. All right, and like I said, there's so many different types of contracts. There's E-minis, but now there's micro E-minis, and even more are coming out all the time, okay? So some of the advantages of trading these, of course, I mentioned already. A lot of them today are, of course, all electronic, but it's pretty much across the board now. And, you know, a couple of years ago, it was more, there was some more pit trading on the larger commodities, but even they've shifted over to the electronic. But it means that you're going to get good fills, okay, levels the playing field. The nice thing about E-minis and micros is you can trade futures now with a lower account. You know, if you trade the regular full S&P 500, those are expensive. But if you go down to the micros, it's manageable on a more moderate size trading account. So a big plus, and these markets are pretty much 24 hours for the most part, not exact. All right, talk a little bit about the continuous versus the dated price history for futures. So what does that mean? Basically, whenever you trade a futures contract, it has to be a specific contract. For example, if you're doing the MES, it would be the MES March, 2023 contract. Okay. However, if you want to look and take a position trade in something, you may want to choose a contract further out, and you may have to look based on your analysis of Elliott Wave and everything else, look at more than what the current contract's history has. So they have continuous contracts, which basically kind of knit together all the history of that vehicle that was traded, and therefore you get a clean picture of years and years, if not decades, of price fluctuation or price history on that specific contract. So you use continuous contracts, for example, if you were looking at a weekly chart of the S&P E-mini, okay, because it ties them together so you can go back that far instead of just looking at one contract that has a start and a limited finish, okay? So that's kind of the deal with that. But when it comes time to actually execute the trade, you will have to pick out a specific dated contract. And when you day trade, you're not going to be bothering with continuous contracts. You're just going to be using the front runner contract date. All right, some pitfalls, of course, When we talk about expiration dates, now we talk about what expiration date to use. And that's going to be dependent upon what your target price is, where current prices are, and how far away you are from your target. Because if it's going to take, what you think is a month to get there, well, then you have to, basically choose the appropriate futures contract. If you think it's going to take a year to get there, well, you have to take that into consideration as well. And there's a lot of great software. We have some software available in our client support area, that area log into. And you can purchase this, and we have a great discount on it. We don't get paid from them or anything, so it's a savings we offer you. And it's called Options Play. And it's a great place for you to learn how to do options trading. And they have options primarily on stocks. But the idea is, in that software, what you do is you pick out the price you think it's going to, and then that adjusts what contract you should buy. So you can kind of correlate that into futures too. You wouldn't use that for futures, but the same thinking comes into place. So whatever the price is, if it's got to double, then you've got to give it time. That's my point, okay? And then you have to see what the pricing is on each individual contract. So you want to always use risk control when trading futures, just like you do stocks. So that doesn't change. All right. And of course, avoid taking delivery unless you want to. Okay. And watch your margin and leverage, because if you're over margined or cutting it really close and you have one of those limit up or limit down days, you're going to get called for a margin call more than likely. And that could mean that you have to sell your position out before you want to. You got to be careful about that. And you can use the trade size calculator or the risk reward calculator in the futures market. Okay, it's perfectly acceptable for that. We use it every day in our day trading room. And basically that's how we determine the number of contracts we want to buy or sell when we take a trade. All right, some advanced things to talk about really quickly here. Seasonality, okay, the CBOE reports, Elliott wave, etc. So let's quickly dive into that. All right, there is many people out there that love the seasonality reports for the futures markets, and they're really a bit more for agricultural than anything else, because, for example, winter months versus the harvest months and things like that come into play. So prices of goods are subject to seasonal tendencies as a result of natural processes, other important annual events which can create yearly cycles in supply and demand. Not an issue for day traders, just not. You don't have to worry about this because you're going to be in and out in one day. So that's not an issue. But for long-term people, they may want to take a look at this, and that will all come into the continuous contracts when you look at those. And when you apply the Elliott wave, you should see the seasonal movements in that as well. All right. And again, like other markets, the futures represent collective traders' mood swings for pessimism and optimism. Elliott wave price patterns represent these swings in the visual price patterns and the labeling of the waves. Trends move in 5 waves in the Elliott wave, pulsive corrective waves, just like in stocks. All right. And so everything is pretty much the same. And target zones and everything, we use those fibs. So no change there, no big difference there at all. Now, this gets a little tricky. I don't really advise doing options on futures for new people. It can get pretty complex and pretty leveraged pretty quickly. I would wait until you have a really good understanding of futures and specifically the markets you're trading before I would attempt to do options. Just my suggestion. But let's just go over these really quickly. An option on a futures contract gives the holder the right to enter into a specified futures contract. If the option is exercised, the initial holder of the option would enter into the long side of the contract and would buy the underlying asset at the futures price. Now, the big difference between options on futures and options on stocks is you have ticks that are varying. So it's not always the same like it is on stocks. But let's talk about a short option on futures contracts. Lets an investor enter into a futures contract as the short would be required to sell the underlying asset on the futures date as a specified price. So it can get a little complicated. So you got to think this through. All right. If once you get all the ticks down and you get used to how futures work, then starting to use options on that will be a lot easier to conceptualize. Options on futures can allow you to trade with superior margin rules known as span margin, which allow for more efficient use of your trading capital. That's why the more advanced players use options. They like that. There is, however, and here's what I'm getting at, a key difference between futures and stock options. A $1 change in the stock option is equivalent to $1 per share, which is uniform for all stocks. However, for example, if you were doing this with the S&P futures, a $1 change in price is worth $250 per contract. And this is not uniform for all futures and future options market because the ticks are different, or at least can be different, for each individual futures market you trade. So every time you do an options on a specific futures, you got to take into account what the ticks are in that particular futures contract, because that'll affect your option play or profit and loss from your option. All right, now again, going back one more step here to more long-term trades here. There are a lot of reports, the COT report, which is the commitment of traders. You got the TFF, which is the traders in financial futures, agricultural reports, and basically they use these reports for primarily seasonality type of looking into, but also to they kind of basically reports or what the bigger hedge funds and or actually institutions are doing. These are your people that purchase large quantities of futures contracts because it's their business. You know, like General Mills in the business of doing that for grain, things like that. So also oil companies do this in the futures oil market, things like that. So big companies do that, and people, smaller traders, like to see what they're doing and how that could affect prices going forward. You know, what's the demand, what's the supply type of thing. Of course, being technical traders, I tend to really rely on price to tell me everything I want to know. All right, just a quick example so you kind of get familiar a little bit. I'm just going to choose the E-mini contract here. So let's just go through that. So the normal symbol is the ES. If you're trading the micro, it's going to be the MES. And M would stand for the micro on that. All right, it's Globex. All right, it's 50 times the normal index, $50 normal index is the ratio. Very high liquidity, great market to day trade. Tick size is a 1/4 point. So there's 4 movements in a point, all right, at 25 in intervals of 0.25. And so therefore each point, each 1/4 point is $12.50. So a full point is going to be $50. So when you're looking at the trade size calculator, for example, you're going to be putting in $50 where it says what's the point value. And the reason you do that is to calibrate the calculator. Now, if this was the MES contract, this would be $5, and that's what you would put into the calculator, okay? So a little difference there, right? All right, and then the contract months are HMUZ, and depending on what broker you're using, they may not use the alphabets to represent the months. I know in NinjaTrader, they do not. For example, in NinjaTrader, they just use 03 for the March, and if it's 23, it's 03-23. All right, but some platforms do use the letters. So basically, normally what happens is you got the, and again, this is going to vary from broker to broker and data provider to data provider, but the root symbol, okay, this is probably always going to remain the same. The contract month and the year can be represented either from the alphabet or actually from the numerical side. All right, so that's kind of how they do that. This is an example of just an S&P E-mini on a 10-minute time frame, but you can see, you know, if I remove the X and Y axis, you wouldn't know if you were trading a stock or a futures contract, because the technical analysis will see the same type of patterns regardless of the type of market. So therefore, you can use the ART software, you can use the ALP, ETF, TLM, etc., all on the futures market, just like you do in stocks. So all our trading decisions are no different than how we make them in the stocks. The only difference is you got to take into consideration the ticks and the differences between, futures and stocks like margin and things like that. But all the, drawing in the fibs, that's all the same. Counting the Elliott wave, that's all the same. 3, 4, 5 type of thing. So all that's the same, exactly the same. That doesn't change. And you can see it across a wide variety of markets. There's our target for wave 5. So if you wanted to go short, you would just sell X number of contracts, put your stop up here, do your trade size, and you're good to go. Just like stocks, the only difference is it's contracts. But you do get more leverage, okay? So if you got in here on this, all right, with initial stop up here, 11 contracts, 2% risk on a $50,000 account, all right, and then got stopped out here, okay, your entry here, exit here, 14 points, $712 a contract, or $7,837.50 for 11 contracts, and that was done between here and here. So pretty sure, all within a day. Okay, all within a day. So you can make some big money doing this because of the leverage. So that's another reason people like to, day trade the stocks. All right, and here's the trade size calculator being used over here. The 2%. Notice the point value in the calculator is 50. All right, the risk is 2. Up here, commissions, margin. All right, there's your 11 contracts. So what we basically are doing here is saying, okay, we went in here. All right, if we get stopped out, our stop is here, and we're going to lose $964. All right, but that's worth the risk of taking it all the way down here. Okay, so I'll risk all day long $1,000 to make that $7,000. That's 7.8 risk to reward in my favor, right? Can't beat that. So that's the advantages. All right, so that's it. All right, so any questions on that? I'm going to throw out here. This is something you guys may want to consider. We have a day trading room on Tuesdays and Thursdays. So we put together something for you where you can get 30% off on the room. And Gene will put the link up in the chat area if you want to join us. We meet Tuesdays and Thursdays, 2 hours each day. You're going to learn a hell of a lot in this room. It's a great room. We trade the 1-minute time frame. We also look at the 5-minute and the 15-second. So we use multiple time frame analysis when we're day trading. We're using the ART software, all our indicators, and Elliott wave along with fibs, just like on those charts you saw. So we do that every day. The markets we trade are the MES, the MNQ. So these are all affordable markets. We trade the MCL, which is the crude oil micro. We trade the micro gold. We look at the micro NASDAQ, of course, E-mini, Russell, all right, M2K contract, and anything with high liquidity, Dow micro, the Dow micro, MYM, I think that is the one we trade on that. So all those are done in the futures day trading room, and it's great. We keep track of all the results. So as a subscriber, you can see exactly what we've done over the last 2 years in this day trading room, and we've been up last year and we're up this year. So we have a lot of fun. We also test ideas. If you come in and say, hey, can you test something? Then we'll test it for 30 trades. And if it doesn't work, then we'll go back to the way we were doing it, bring the account back up, and then we can test other ideas as well. So it's very flexible, very fun. All right, and it's something you really may want to consider. All right, so that is it. Thank you. Great session today, Jeannie. Thank you so much.
Well, great session and great group. And we have a couple of our day trading room folks in the room as we speak. So how fun is that? It's a great group, guys and gals. We have a few gals too. I know Rebecca definitely is a regular in the room, and Bill's here. Good to see you, Bill. But anyway, Bennett, I posted the link for the day trading room, and I guess that's about it. So we'll wrap it up and hope you all have a great night. And join us for the next Wednesday Night Live, which is on the 4th Wednesday of every month. So we'll have a new topic for March, and we'll see you next time.
All right, super. Thanks, Jeannie. And we did pretty good on the time. A lot to cover today, but we kept it under 45 minutes, so not too bad. All right, everybody, have a good one, and we'll see you next month. Bye-bye.